I'd like to welcome you to our rapporteur feedback session for the Government Roundtable that we ran on the 2nd of December last year at Resourcing Tomorrow. The Government Roundtable, hosted at the London Stock Exchange, brought together an extraordinary assembly of representatives from 42 governments, industry leaders, miners, traders and experts to tackle pressing issues shaping the future of the mining and critical minerals sector. It was sponsored by Barclays, DSS Plus, Stratum International, the Weir Group and White & Case. This rapporteur feedback webinar will provide you with an opportunity to listen to the rapporteurs from each of the sessions and then ask them questions, which you can do so in the chat function at the bottom of your screen. To tell us a little bit more about today's session, I'd like to introduce Fiona Clowder, who has a variety of industry roles, including founder of her own company, Clowder Vista, as well as senior advisory for Appian Capital Advisory. The floor is yours, Fiona.
Thank you very much, Andrew. It's always a pleasure to participate in Resourcing Tomorrow and associated events, which have become key elements of the mining calendar. And the Government Roundtable, or really to be more accurate, I think Intergovernmental Roundtable, this independent initiative by Resourcing Tomorrow to bring countries and other players together was a really important innovation in the conference this year, and one that I hope will be continued. As Andrew said, there were 42 countries, many international organisations and leading industry figures came together not just talk, but share ideas for action on the urgency for the mining sector. The urgency of the global need of a rapid scale-up of the volume of materials needed for both the energy transition and continued economic growth around the world. The urgency to ensure this is done in a rapidly changing world of shifting geopolitics as well as increasing climate impacts. So the urgency of developing secure, resilient supply chains. The urgency to ensure all this is done in a way that builds partnerships and brings benefits to communities and the countries with the mineral resources. The urgency to ensure all this is done in a nature positive way, showing that prosperity can help protect the environment. And the urgency and scale of the investment needed to make it happen. We are all in this together, and it's only by working together internationally that we can address these global challenges. It is only by working together across sectors that we can galvanise the momentum to make this happen. And that's also why it was important that this roundtable took place at the London Stock Exchange, heart of the City of London with its long history. The oldest listed company on the stock exchange is, after all, a mining company, Antofagasta. And the city's overall unique convening power, as demonstrated through its recent work on green finance, now there is an opportunity to really advance sustainability, inclusivity, and investment in mining and critical minerals. So the three groups, which my colleagues are going to talk about at the roundtable, focused on overcoming geopolitical tensions and ensuring security of supply to meet the needs of the energy transition. Discussions which highlighted strategies to navigate climate vulnerabilities while securing critical minerals. A second group looked at the financing challenges faced across different stages of the mining lifecycle and value chain, including innovative investment models and collaboration opportunities. And a third group looked at streaming permitting timelines without compromising ESG standards, stressing regulatory efficiency alongside environmental and social accountability. 4 expert rapporteurs ensured that the roundtables focus on insights and action. Isabelle Dupras, the Deputy Editor of the European Initiative for Energy Security, Tom Attenborough, Head of International Business Development, Primary Markets for London Stock Exchange Group, Alan Taylor, Partner for White & Case, and Remy Piet, Co-founder and Senior Partner of Emberley, advisory. I'm now going to hand over to Isabel and Remy and the others to take us through some of the detail. And what is important is that this is now followed up by people on the ground so that for next year's meeting, we're building on action and progress. Isabel, Remy, over to you.
Thank you, Fiona, and thank you to Resourcing Tomorrow for this great initiative. My name is Isabelle Duprat. I'm the Deputy Director of the European Initiative for Energy Security, EYES. EYES is the European project of SAFE and is an organization that was launched in the wake of Russia's invasion of Ukraine to develop and champion solutions that de-risk Europe's energy transition and address strategic dependencies emerging from the transition from fossil fuels towards the minerals-based economy. We had an extremely interesting discussion focused on overcoming geopolitical tensions. And before diving in, I want to highlight the three dimensions that we covered. The first being geopolitical tensions in the context of China's acts of economic coercion for minerals through its market control, systemic market distortion, and predatory pricing. In Europe, certain countries like Serbia have become battlegrounds for Western and Sino-Russian interests. Yadar, in particular, is facing lengthy delays and has been infiltrated by misinformation campaigns. And since our discussion in December, Russian troops have been inching closer to one of Ukraine's largest lithium deposits. So there's this first framing that we discussed. The second is sort of with this in mind, number of governments, particularly the United States, have been using the tool of industrial policy to intervene and redress strategic market imbalances through regulations and incentives, such as the 30D tax credit. And these levels of intervention are quite unprecedented for our current day and age of free market libertarianism, and have major implications for the investment landscape and project viability. Today's trade landscape is very different. We've seen a doubling in trade barriers for minerals in the last 2 years since 2022. And this has soured some international partnerships, which are critical for securing minerals. We also talked about the framing of geopolitical tensions in the context of sub-Saharan Africa, with civil unrest in Mali and Niger, and regional tensions. And for the sake of this webinar and our discussion, I want to focus on the first two. And we discussed the need for deliberate and targeted coordinated action. Canada and Australia have developed proactive approaches to critical minerals development and recognize the overdependency on China that poses a strategic risk to economic security and national security. Both countries emphasize diversifying and boosting domestic production while focusing on the midstream. Canada integrates environmental, social, and governance practices with a cross-ministerial government support that secures and unlocks mineral supplies. And I really want to emphasize this cross-ministerial support of and regulatory harmonization. Its provincial strategy also emphasizes efficient supply chains, which have accelerated mine development and streamlined regulation and permitting, reducing the time to begin extraction to 5 years in Canada. Australia as well has been focusing very heavily on the midstream midstream off-takers, and processing in order to address concentrations of processing in China. Market volatility and price instability remains a challenge. Australia has been also seeking to improve the bankability of projects through improving access to debt and equity. And this has been done extremely effectively through its export credit agency and through a 10% critical minimum production tax credit. These are important lessons learned for other jurisdictions that are seeking to secure their mineral supplies, particularly in Europe, with an emphasis on this vertical and horizontal regulatory harmonization. We also got to talking about ESG regulations and the fact that these are occasionally conflicting with aspirations to explore in new jurisdictions. We talked about the Arabian Indian Shield and new opportunities for exploration there. And we talked about ESG in the context of taxonomy that relates to financial institutions and the need to streamline across regulation, and for political aspirations to be also reflected in financial institutions through political leadership. I'll hand over to Remy because I know that he has a lot of other interesting points to add. Thank you.
Well, thank you very much, Isabel, for passing me the torch here.
Thank you very much.
So, go for it, Fina.
Okay, Remy, just before you start, can I just remind our audience that questions can be submitted through the chat function, and we'll be pausing after Remy has spoken to take questions on this first session on the geopolitical risks involved, and then we'll be moving to our other speakers, and then we'll have a further Q&A at the end of the seminar. So Remy, back to you.
Thank you, Fiona and Isabel. No, very good. It was an extraordinary event. The fact that we had representative of them more than 40 countries from different areas in the world, both producing countries and more traditionally consuming countries of mineral production, really gave us a comprehensive and holistic view of the series of tensions, but also opportunities into the mineral processing chains at a time where energy transition is so important for the world. In terms of those issues that were focusing especially on geopolitical tensions, I was very lucky to have around on my table, representative from countries that have unfortunately, faced a series of conflicts, from Armenia to Georgia and Kosovo, also countries in the Middle East that actually explained, the perception and the situation that they were facing in their energy transition strategy or critical mineral strategy, and especially the capacity that they would have in terms of exporting their production. In the case of Armenia, especially discussions of how there could be new export routes and how to make sure that you can actually export copper despite different blockades or difficulties to export minerals. Questions also in terms of the security of trade routes were reasoned, and so it was quite interesting to get a different perception on those issues. A second element that was I think essential was the question of financial barriers that were limiting investment, and obviously the mining sectors, especially in terms of exploration, has seen difficulties in its capacity to raise capital in some of in the series of frontier jurisdictions specifically. This is also the case for artisanal miners. That was a key topic that was addressed during the conversation in terms of being able to find good sources of capital to move forward on a series of smaller scale production, but making sure that you actually were able also to provide a more mid to long term roadmap in terms of of how capital could be disbursed and what could be some exit strategy from different investors. In the case of financial barriers, there were some discussion about exploring alternative routes for financing through different international organizations. Also, the rise of different actors, some sovereign wealth funds, for example, from the Middle East or others that have been extremely active in ensuring the security of supplies for some of their industries, and that also led to discussions about potential competition over scarce resources, especially over projects that were near completion, near production, that have been experiencing a very high cost of entry for investors, as opposed to more longer term projects and exploration projects that are suffering from the lack of access from financing. Obviously, one of the key element of the conversation in terms of geopolitical tensions in global supply chains was linked to the competition between the US and China, or more generally between the Western world and the up and rising BRICS countries, and the issue that obviously the status that the as of today, a lot, if not an extremely large majority of transforming chains and especially for critical minerals were today present in China, that gives the country a dominance into the critical mineral processing areas that have created a challenge from other countries that are completely dependent on exports from China, and the capacity also from China to potentially skew the international market by raising barriers or even threatening to stop the exports of similar commodities. It was the case for magnesium, the case for rare earth. We've seen it over the past, and the extreme emergency and need for other countries, whether the North America, United States, Canada, also Europe, to make sure that they were able to maintain or to create other alternatives for the production of key elements for the industrial sectors, by either developing in a very short amount of time alternative processing chains in lithium, in critical minerals, and others in rare earth, for example. And so as a result, not being dependent on production from China, and potentially at the same time also push for alternative ESG approach to production, maybe more sustainable development of new technologies on those aspects. So all those issues were central to the discussion of competition between different powers on global supply chains, and also led to further discussions on who controls the creation of value in those mineral processing chains, whether you're looking at countries that have specialized their economy on the extraction of minerals but haven't had the capacity or the opportunity to climb the ladder of value production through processing, and other countries that would actually really are ready to be let's say more aggressive in seizing assets, but securing also that the production will be done and transformation will be done in their country. Obviously here the main element is the factor of risks is extremely present into early stage project, into extraction, into junior miners, much less into the end side of the processing chains for transformation of those minerals. And at the top, not only do countries where extractive industries and production of minerals in Latin America and Africa are facing more risks for investors, they also are not capturing the value of the production and the value of the processing chains, since they're only exporting raw materials. And so a lot of different discussions were led onto what kind of bilateral or more global agreement could be developed to try to have a more balanced and more, let's say, fair approach to the development of new commodities projects, especially in copper, rare earth, manganese, lithium, and making sure that you would have larger long-scale partnership between different countries, producing countries and transforming countries or markets, and extractive industries-led countries, in terms of being sure that there are stable market stability also for investors, and that the value creation in through those supply chains were quite fairly shared between the different countries. There were a few elements, maybe I don't want to spend much time on this, and I'm more happy to answer questions later, but in terms of whose role and who was more responsible in terms of taking a stake into this, whether it's the role of private industries versus government, how the government should be working with mining companies and others in terms of providing some of safe investment environment, but at the same time how companies should not be playing the game of the race to the bottom in terms of regulations, and instead being a long-term partner in some of the countries to make sure that this also will create the condition for long-lasting growth. We had a few case studies in South America. We talked about Ecuador specifically. In Africa, we talked about a series of countries around the Great Lakes region. In Southeast Asia, where there's conversation, especially on how some countries are working to attract investment, although they're facing potential security challenges or of their proximity with China. And all these were, probably tied down with the last question that was on, ESG consideration, whether, ESG was a factor that was hampering additional investment, or quite the opposite. If ESG was not a competitive advantage from European and North American countries or companies pushing for more of an ESG compliant framework of investment and production, in the sense that would actually allow them to build more long-term partnership with especially African or Latin American countries, and not just a short-term vision that some countries were arguing that Chinese companies might have, and therefore it would be down the road of the best interest of producing countries in Africa and Latin America to partner more with Western countries pushing for ESG consideration and standards, because these include key factors such as elements of local content, elements of circular economy, and obviously limitation of risks to the environment and social cohesion of each country. So all in all, it was really fascinating conversation due to the fact that we had around the table representatives from many diverse countries that are facing challenges on different levels of that question of securities of supplies. Also members of the private sectors and key thought leaders and academics in London. So it was a very fruitful conversation, and I'm more than happy to answer some of the questions in the future. Thank you, Fiona.
Thank you very much, Remy, and to Isabel for that comprehensive overview of those very important sessions that covered the geopolitics. Just to remind our audience, you're very welcome to post questions in the chat, and we'll do our best to answer them either during the seminar or in the more comprehensive Q&A at the end. But just whilst we're on geopolitics, and before we move to our next speaker, of course, the big, I was going to say elephant in the room, but perhaps the big question in the room is the advent of President Trump in the US, a very different approach. There was also issued last week an interesting report from SAFE in the US. In fact, Dominic Raab, my colleague at Appian, chaired the working group that contributed to that report. And that's looking at resources for resources, financing critical mineral supply chains, and highlighting some things you've just been talking about, the unprecedented market dominance by China, investment barriers, and trying to come up with a roadmap to enable an investment climate. So could Isabel, Remy, could you just very quickly comment on the advent of President Trump? What does this mean for the world of critical minerals?
Oh, me, Isabel, please feel free to start.
So I think what we've seen with President Trump is that he will be taking a more unilateral approach to some of these partnerships, whereas the Biden administration had taken a more multilateral approach through initiatives like the Mineral Security Partnership. We'll be seeing a transition towards, bilateral and unilateral debates and discussions. We could talk about Greenland as well. I might pass to Remy to take the baton from me at this point.
Happy to do so. I mean, obviously you're looking at a more rise of protectionist barriers and potentially let's say a different direction towards the energy transition, favoring potentially more classic fossil fuels, source of energy. But I think more generally that the revolution towards EV battery vehicles or towards electrification of grids, using renewable energy and therefore critical minerals is something that is a given. I mean, it's not that there won't be a 180% and 180 degrees on this question. Even the Inflation Reduction Act is actually very much supported by a series of actors in the industrial sector in the US. So you might need to see a rebranding of it, but I don't believe there'd be a change of most of the incentives on that front. The key element is probably, as I was saying, the rise of trade barriers, especially for EV metal, EV metals commodities or electric cars, and that will lead to the need for additional projects in North America. There's quite a few. You have Avalon in Canada. You have Tesla production chain in Texas, for example, that are trying to catch up with what I was mentioning in the fact that there was an overbearing presence of China across the transformation of lithium and across the transformation of rare earth. So that will create great opportunities for investors in North America into some of those projects. But we are nowhere near, the levels of production and in the short term that you will see in China. So there will be a crunch into this. There will be an increase of prices in the short term because you will need still to rely on imports from traditionally producing countries in China until North America is able to catch up. But for investors, clear opportunities to invest into processing chains of critical minerals in North America. It makes it also that the projects in North America become, in terms of extraction, becomes much more interesting. And in the short run, obviously, an impact on prices that will be probably more supported by consumers onto this. But there will not be, for me, a complete turnaround in terms of the key decision that were made even by consumers on their habits of production. We still need to have commodity minerals that are being processed, but there needs to be a relocalization of those processing chains to North America in the case of the Trump administration, with a more antagonistic perspective with other usually traditional partners in the European Union and others on the front of the way that those production will be made, whether it's sustainably or not. We've seen great strive and progress in terms of emission reduction, in terms of scope 1, scope 3 reporting that was encouraging the sustainable extraction and processing of mineral supply chains. That might be somewhat tempered or halted, but it's still into the best interest of most businesses to do so. And when you look at recent interviews, even from ExxonMobil CEOs or others that were talking about the pulling out of the Paris Accord, it is still very important for energy companies or mining companies to abide by a series of key ESG approach, because it is a business decision and it is a risk mitigating approach. So I would say relocalization of supply chains, but no real impact in terms of that evolution towards energy transition that we're seeing, and especially the fact that despite the rhetoric that might be less inclusive on ESG, it is still a good business decision to avoid risks when you don't have the right processes in place.
And Remy, I very much agree with you, and that obviously this is a big change in the politics, but fundamentally the challenges facing the world remain the same, and there needs to be this gearing up of the mining sector, and this is a tremendous opportunity. I think the International Energy Agency, the IEA, projected the market for critical minerals to nearly double from 325 billion last year to $590 billion next year, by 2040. And when you think of the inherent supply chains and associated businesses in that, this is an economic opportunity for the world. So I'd now like to turn to Tom to give us an overview of the main findings from the group that talked about addressing the different financing challenges across different stages of the mining life cycle and the value chain. Tom, over to you.
Many thanks, Fiona. Good afternoon, everyone, or indeed good morning or good evening, depending on where you're joining us from today. I can see, just looking through the attendees, that there's quite a variety of jurisdictions from which you're coming, so you're all warmly welcome. To add to the comments that both Remy and Isabel have made, and indeed Fiona, about the diversity of attendees at the event, I thought this was a fascinating cross section, and getting sort of governments, the private sector, other stakeholders in a room to discuss these matters, particularly when the companies represented were very much at the sort of top and bottom of the market cap spectrum, and really range from juniors who are at a very early stage in terms of project identification and exploration, and majors at the other end, made for a very, very sort of rounded discussion, and hopefully some conclusions drawn out of that were effectively sort of cross cross sector, if that makes sense. But our conversations really, I think, in both the sessions that we ran, started off by trying to identify, the issue and put our finger on the scale of the issue, and sort of what it meant. A lot of those have been touched on, so I won't spend too much time on it. But of course, the backdrop to this was the EY report at the end of last year that annually looks at the top 10 risks in the sector, of which in the last edition, access to capital is absolutely the top of that, and right in the in sort of everyone's, I think, mind's eye as to one of the biggest challenges. I think there is, the starting point for a lot of discussion was that public markets alone were not seen as being there in sufficient depth to address the huge quantity of capital investment that was going to be needed by the sector as a whole, and that is only going to accelerate, of course, notwithstanding some of the implications of President Trump's Trump 2 arrival, but the acceleration into the energy transition, EVs, etc., is only going to accelerate that huge capital need. I think a realization that actually this was exacerbated a little bit by challenges at both ends of the market cap spectrum. Those at the smaller end of the market cap spectrum were finding it difficult to find equity market support. There's a number of reasons for that. I think the quantum of asset managers available who invest in small and micro caps has certainly declined, over the years. The retail investor participation in the sector has arguably gone down a little bit as they found other asset classes to invest in, whether that's debt in an interest rate high or fixed income in a higher rate environment, whether that's crypto or other sort of asset classes, etc. So at the early stage, people are, I think, around the world are finding it sort of difficult to come by new capital. And I think at the other end, you've got a lot of the majors who feel that they need to be part of the solution, but who remain pretty frustrated in a sense that they feel that they are constrained as a management team and as a board by the desire of their investors to be much more risk averse, pay dividends, and not necessarily add to the risk profile by going out looking for a lot of new projects. So I think those two things sort of coinciding, meaning that as a net result, fewer projects are being discovered, fewer projects are being developed. And I think if there was one quote from the session that really seemed to sum up, the challenge, is that one of the attendees said there is too big a discrepancy between the commercial value of the sector and its strategic value. And I think if many people on this call, all of you, will sort of recognise that in terms of the on the one hand the requirement that we all see in front of us, and on the other the challenges of actually getting the capital to sort of bridge that gap and how we can go about it. I think there was then a sort of really constructive conversation about that given that everyone owns the problem, who can help solve it, and who can help contribute to to solving it. And I think we probably started by saying what can be the role of governments in trying to sort of bridge the gap, and that ranged from consistency and stability of regulatory frameworks and sustainability standards, for example, establishing those clear frameworks in which companies operate, not moving goalposts, so that companies can sort of operate in a very straightforward way. A lot of discussion about streamlining the permitting process for new developments, and I think in some jurisdictions that are more aggressive, perhaps newer to the sector, you're seeing permitting done in a matter of months, whereas in many jurisdictions that are perhaps a bit more established across the world as mining sectors, this can often take 10 or 15 years to get sort of fully permit in place for development, and which I think, given the urgency of what we're looking at, was seen by everyone as being sort of too long. Of course, a lot of the non-government participants in the room all said tax incentives and fiscal encouragement, which again will surprise no one dialing into this. But I think again some of the there were some very progressive governments, both regionally and nationally, in the room who were talking about tax breaks, credits, etc. for exploration development activities, which I think again can get investment on the ground and help ultimately sort of lead off and crowd in external investment. Research and innovation, and again tax breaks around that were seen as again something the government could lean into. Stockpiling, establishing sort of strategic reserves is something that I think people could look at governments at doing more of, so that ultimately people see less of a sort of cliff edge in the future as supply dwindles versus demand. I think lots of discussion around collaboration, and again some of the points that I think Remy and Isabel both touched on. I think people realise that this is a global challenge, and that therefore the more collaboration there can be with between countries, trade agreements in place, etc. That's only going to be a good thing in terms of reducing overall costs and allowing companies to really feel that they've got a clear road ahead of them in which to operate with a lot of the barriers removed. I suspect that is an area where in the world of Trump 2 and tariffs, arguably since we held this on the 2nd of December, is getting more complicated rather than less, as Remy and Isabel have both sort of commented on. But I think those were some of the issues that people felt that government needed to lean into. I think people also felt that, of course, you can't just sit and wait for government sectors to do everything. What are the things that can that again the sort of private sector can get on with? One is to find alternative sources of capital. Of course, easier said than done. But I agree with some of the points Remy made in the start of his comments, that there are other actors now on the scene. There are sovereign wealth funds around the world that are leaning into the sector a little bit more. There are one or two areas in which you're seeing some slightly more innovative tax friendly structures, such as flow through shares in Canada, which helps trading houses, etc., even private equity, which has been a little bit patchy, but we have seen that sort of come through as well. And again, I think a lot of conversation about some project financing and the cost of that. And again, it goes back to what we're talking about, sort of government's roles, is that if sort of ECAs, DFIs could really sort of underwrite some of those sort of project facilities, then crowding other investors in would be far easier. So again, practical way there of sort of government and private sector potentially sort of working hand in hand to be sort of part of that problem solution. I think interestingly, there was quite a lot of discussion between the corporates in the room over the two panels about things that they can do to help change the narrative around the mining sector as part of their sort of capital raising challenge. I think, I think there were, more than one company that raised the issue of, that one of the problems is, of course, we're seen as someone who not only operates in a very volatile environment where you have to make long-term decisions against moving, commodity prices, which makes it very difficult to take long-term economic decisions. But you're also too often being seen in this environment as someone who creates environmental liabilities rather than sort of solves world problems. So I think the importance of changing that narrative, particularly with the sort of younger investing generation coming through, to say, we're not just digging holes in the ground and spoiling the planet. We are actually, solving problems, and we're doing it in a responsible way, was something that I think very much sat back with the companies as something they needed to do through their own sort of investor relations and storytelling as they go about sort of raising capital and changing those investor perceptions, over time, which I think would ease things. We then touched, and finally, I'm sort of conscious of time, a little bit more on what sort of we as an exchange and other exchanges around the world are trying to do to help sort of revitalize public markets generally, and of course for the sector in particular. I think some people were quite surprised when I ran through some of the numbers that actually, despite some of the narrative you see popping up in the press, that nothing's happening in London, it's all a bit dire. That actually London last year was the fifth busiest exchange in terms of equity raised on market last year. It raised about twice the amount of equity as Australia, about 3 times as much as Canada last year, and was the biggest European exchange in terms of equity raised by a factor of about 3. So I think there was some level setting going on in terms of actual activity levels on markets, which was helpful. And that's actually, when you look at the market cap of the global mining sector, London still, with its 170 companies on market, represents about 15-16% of the global mining market cap. So it's still a sector that's important to us, and that we're keen to continue to sort of support and nourish. I think there are a number of things on the supply side that have been sort of taken on board in the last sort of couple of years to try and make London an easier place to be doing business. I won't go into all of that. But many people know that the new and updated listing rules that came in last year, which really represent a once in a generation change in the whole listing regulatory framework, both in terms of eligibility to get onto market in the first place, but also the flexibility around further capital raising once you're on market. So again, for capital hungry issuers on market, a lot of those changes should be very constructive. So I think on the supply side, things are in a much better position. Clearly, we are working very sort of tirelessly on with the rest of the ecosystem in lobbying government around what we can do on the demand side. Now that's partly around getting retail investors more enfranchised and active in across the board, but also in a sector where historically they've probably played quite a big role in early stage investing. But also, as the government thinks about sort of pension fund reform and trying to get more sort of assets in the UK pension system deployed in UK assets, be they public market companies, private companies, infrastructure, etc. I think a lot of talk about that and where that might take us. And while I'm not going to comment on what UK government policy is from here, they've clearly made it a manifesto pledge to continue pension fund reform. There has been some early stage announcements around the agglomeration of many small UK sort of government pension fund schemes into 8 sort of super schemes, which I think would be helpful in terms of encouraging them to have sort of greater risk appetite with more capital operating across a across a larger sort of clientele. And I think the government is clearly looking at other things they can do to encourage those the pension pot in the UK, which is the second biggest pension pot globally, to put more into the UK, whether that's ultimately by mandating or whether it's fiscal encouragement. Let's wait and see. But I think we'll there'll be more on that soon. So again, very good round of discussion, and I think some as everyone left the room, we're very much aware that there was no single silver bullet or magic wand that was going to solve everything. But there were some very clear things that sat in both us as an exchange, with investors and their risk appetite, with companies themselves and the narrative, and indeed what government could do to move the needle in making sure investment flowed better. So I'll pause there. But thank you.
Thank you very much, Tom. A very important overview there. Time is not against us, but I know we do have a quick question. Andrew?
Yes, thank you very much for that, Fiona. And just as a quick correction to what I was saying earlier, if anyone wants to ask a question, please post it into the Q&A box rather than the chat box, and then Fiona will go and pick that up at the end. The question that I'd like to ask you, Tom, and I think also might lead into our next presenter as well, is you talked about the importance of getting in new investors, such as government investors and retail investors. But what about ESG investors and impact funds? What are your thoughts on that?
I think, Andrew, it's a really important point. It's probably one of the, the last sort of few years, it's been probably the fastest growing asset class, either through dedicated funds or through sort of generalist funds that have increasingly layered ESG, or climate transition screens, across the top of their portfolios to increase weightings, in that regard. So I think the more that can be done to stress the impact, and sort of sustainable credentials, of a lot of these the critical minerals and their role in the critical role in the energy transition, the more of those funds can be sort of crowded into to things like this. I think we're seeing pockets of that at the moment, but I think that's something that we could see scale, and it'll go back a little bit to some of the points I made about the storytelling and narrative, sort of changing in sync with that in order to be able to really access those funds.
Okay, thank you very much, Tom. And I think also, as you said in your talk, it's also about creating the overall ecosystem. It's both the investment in the mining companies, but it's also attracting others who can help with innovation, different approaches in the sector, allying this to the energy transition, other economic opportunities. So I'm now going to turn to Alan and Remy again, because another part of this very complex jigsaw puzzle around mining is about how can permitting timelines be streamlined, be accelerated, whilst maintaining the rigour and without compromising ESG concerns. So Alan, could you take us through the group's findings on that theme?
Yeah, happy to, so, and Remy sort of hopefully chip in afterwards. It was interesting that these seminars will run in parallel, and obviously very popular to run in parallel, and two of them. I think first and foremost, the move on ESG, it's not just environmental, social and governance, it's around sustainability, and sustainability has always been key for mining companies. They are driven by sustainability, and therefore everybody agreed that ESG issues are fundamental to the permitting process. We need to limit adverse ESG impacts, but improving the permitting timelines. As Tom mentioned, 10 to 15 years on average in Western economies for new mines to move into development. And if we stop and think about that, it means that some of these mines that would be coming on stream in 2025, that the processes started in 2010. And if you think about what ESG regulations were like 15 years ago, and if somebody now wants to start a permitting process and then look forward 15 years, it becomes very uncertain as to how a mine gets developed in the face of these permitting timelines. So everybody accepted that it is important, if at all possible, to accelerate these timelines, but that cannot be at the expense of ESG matters. So we need to think about managing evolving and ever increasing requirements, and often inconsistent requirements imposed by a range of stakeholders, while also continuing to manage to robust standards and limit those adverse externalities. So thinking about this, who sets the relevant requirements? Well, governments do, but that can be at a local, regional, national, or even supranational level. But more and more we see that third-party stakeholders, play a significant role in how mining companies need to react to these ESG requirements. And so again, I think is important, particularly when looking at permitting timelines, to consider who the relevant stakeholders are when mining companies need to address these permitting processes. So multiple stakeholders, multiple obligations, conflicting requirements. How do you ensure that all stakeholders are aligned? And unless you get that alignment, it's going to be a struggle to reduce these permitting timelines. So alignment can come through clarity, through consistency and collaboration. So consultation with regulators at an early stage, consultation with the local communities at an early stage, absolutely critical towards building trust and thinking about the long-term approach to this. We're thinking about efficiency in permitting, not compromising standards. And efficiency in permitting can come through increasing digitalization of processes rather than paper permits, which again we're seeing in a number of jurisdictions. It can come through a single department. Why do you need to talk to the Department of Energy and to talk to the Department of Minerals at the same time? A number of jurisdictions have moved towards a one-stop shop environment. Western Australia, Quebec. Others with more recent mining regulations, as Tom noted, Saudi Arabia. They're talking weeks, or WhatsApp. You're getting approvals on WhatsApp rather than the 30 plus years that you might take in the US in certain circumstances. And it's also the alignment of government, national national standards against local standards. We've seen a lot of waivers as to whether governments are still remain as committed to net zero in quite the same way. And one of the other problems is that consistency of approach. When the ministers in charge of the relevant Department of Minerals change on a rotating basis, when governments change on a regular basis, when officials are unable to keep up with modern developments in mining techniques, that lack of consistency of approach is one of the things that struggles. You may have developed a fantastic relationship with one regulator and they get swapped out and you've got to start again. And again, that consistency of facing a single point of contact in upskilling the permitting process, upskilling the regulators themselves to understand what are the developments in tailing minings and so on, that they're not dealing with technology that is 10, 15 years out of date. That is going to be absolutely critical to improving the permitting process and reducing timelines, but without compromising on ESG standards. So we need to reduce fragmentation. I think, as I mentioned, also the overlapping requirements, satisfying different requirements, so moving to a single unified standard. We're seeing, extra governmental bodies like the ICMM seeking to improve a single standard around, what represents responsible mining. Can that be integrated on a global basis or otherwise? How can you ensure consistency in permitting requirements in one country versus another? And of course, the other one is this cannot be rushed. You cannot rush a permitting process because you raise the risk of corruption. If a permitting process goes through on the quick without proper due consideration, it can raise concerns around corruption, a lack of community engagement, and shortcutting of the necessary stringent requirements to actually demonstrate long-term value from mining companies. And as Tom noted, fewer developments, fewer discoveries. The discoveries that we're finding more and more in rural environments, lack of infrastructure that's going to enable people to be properly educated as to the benefits of these mining companies, again, comes back to the need for long-term trustworthy engagement with communities. So there is no simple solution to this, other than a recognition of alignment between all stakeholders, as much consistency as possible, clarity, communication, as a means to do this against a backdrop of ever volatile commodity prices, that you're going to need mining companies to be thinking 10 years towards a permitting process. It's a very difficult model to be financed.
I'm going to try to add to this. Yes, yeah, I'm going to try to add this. That was already quite comprehensive. I think what was very interesting is, first of all, although that was a Chatham House rules discussions, there were members from across the board on those issues, whether it's government, operators, investors. Every single person around the table has stressed on the importance to have robust environmental, social, and government standards, and that it was in the best interest even if it takes time and it has to be done quite well. It was in the best interest of all around the table for having long-term, sustainable, profitable operations in the mining sector. Another common element was the fact that it was important to involve communities very early, from the very onset of the project, to be able to assess whether or not there was a capacity for the project to move forward, and to make sure that from the very beginning there are good, trustworthy, relations between the different stakeholders involved into a mining project. There were also consensus on the fact that one of the key problems sometimes is the communication between the regulatory bodies in different countries, especially when there's a mix of centralized Jacobin central state organization and federal system, where you also have to get some agreements from at the state level, and sometimes you have to duplicate and multiply the same kind of reporting at different agencies, and that's what usually is wasting time. One interesting element was the question on the global differences in terms of permitting practices. On some countries, Turkey, Saudi Arabia were mentioned. You can have very fast permitting processes, straightforward. On the other side of the spectrum, the many participants mentioned that in the United States specifically, you had very complex situation and legal challenges at different levels of decision-making processes, and that is what has made that the US has lagged behind, together with the NIMBY syndrome, on the development of mine, especially in the critical minerals space. Also, an example was Ivory Coast, where some members have mentioned that it takes sometimes as little as 18 months to move forward in terms of having authorization and permitting in your mine, if you had the right kind of responsible environmental and social practices from the get-go. But definitely, that was a vast difference between countries in terms of permitting. One key element that should never be fast-tracked is the community consultation process. We've seen and discussed some good case practices from Peru, discussions of those discussions of these issues in Ecuador, especially obviously the Latin America is a continent after following the fact that most countries signed the ILO 169 regulations on free and prior informed consent of communities. There has been a series of best practices and engagements, protocols that have shown their efficiency in Latin America that could be replicated in other continents, in other countries. So that was, especially underlined by participants. And an element that was mentioned was the question of corruption, especially when you have different levels of decision making. That's the case in sub-Saharan Africa, for example, where you can sometimes, unfortunately, get a validation of some of the processes to fast track and not on the right bounds, and that actually has led sometimes in some countries, especially in Indonesia. Also, that was an example to the decision of reassessing a national level streamlining of authorization, so that you don't have different models and different systems in different parts of the countries that unfortunately can be negative towards the governance and the long-term viability of your permitting processes, because of the fact that it was not done correctly from the get-go. But I think in terms of conclusion on this, most people agreed, if not all, that even if it takes time to go through the permitting processes, it's also the basis and the assurance that your projects will have a long-term viability. If from the very beginning you have a very strong permitting process, you have a support of communities based on trust, maybe it takes an additional year to do this, but this is what will reassure investors and therefore fast-track other aspects of the development of the project, whether it's drilling campaigns and others, because you're able to mobilize more finance, or whether it is to make sure that you don't have a stoppage of operations like we see in different projects, La Bamba, Las Bambas, or otros, or others, in Latin America, that have been halted because of lack of community support. It is very important not to ensure that the permitting, although as fast track as possible as it can be, is still done very strongly and seriously to ensure the viability and the sustainability of investment from key partners. So I think this was a very interesting conversation on the permitting, because we've seen different practices, different suggestions that were made from different countries and companies sharing their experience in jurisdictions that have put in place best practices and standards. The question of the single window, for example, for permits has been raised a couple of times, showing the efficiency of that approach for a series of jurisdiction, and the fact that if you want to attract good quality investment and responsible investment, there's no way other than actually to have a strong proactive approach to ESG standards and permitting, starting with community consultation, not fearing that you actually bring maybe third parties to facilitate those communication more easily than just a direct relationship between the mining companies and communities that might not be trained enough to be able to strike long-term partnership. But it's extremely important to have from the get-go in the beginning a long-term vision on those questions, and sometimes not facilitated by the fact that, when you start with junior miners that have struggling to raise capital and are just thinking to spin off an asset for another companies, sometimes these approach to permitting can be not taken seriously enough, and that should be a main focus on your due diligence for investors, and a main focus for governments in terms of ensuring that there's a shared value creation and long-term stability of operation in their country. All yours, Fiona.
So Fiona, if I may, there's a
Thank you,
Q&A.
Remy.
There's a Q&A asking about how the Trump administration will influence permitting timelines in the United States. Well, that's a forward-looking question, and as lawyer, we always caution on forward-looking statements. However, I think one of the things is that may seek to improve permitting on federal lands, but let's accept that in the US, as in other countries, indigenous communities have interest in there. What it will not be unable to do is to influence stakeholder litigation, particularly in the US. And again, discussion around Rio and the ability to bring on stream the resolution mine, commentary around, yes, but certain native communities still being significantly powerful and will try and tie it up in courts. So I think that, again, you can address one part of the permitting process, but like whack-a-mole, other things will come up to try and block process. So I think it's going to be wait and see in relation to that.
Thank you, Alan. And I think both Alan and Remy have highlighted the importance of permitting, regulatory processes and community consultation, that ultimately it makes for a better project and better outcomes for everybody. Just before we wrap up, Andrew, I think, Andrew, you have a question you'd like to raise as well.
Yeah, I think it's probably mainly for you, Alan, although Remy, feel free to go and chip in. Alan, in your summary, you talked about obviously the importance of achieving clarity, consistency, and collaboration between multiple stakeholders when it comes to permitting requirements. Is there a particular sort of like case study you can highlight where you think it's been done well?
I think it's easier to say where it's been done badly. Sadly, I'm trying to think about where it will have been done well, and on a prompt basis. I think we heard from representative of the Quebec regional government, and we heard it from representative of Western Australian government, where the single window, you file your permitting application into a single government department, and that coordinates internally with other departments, is a very good example. I think Saudi Arabia, when we were speaking about 15 years for this, or when the new EU requirements were coming in, to say that approvals to be done within 27 months, and the representatives from Saudi Arabia were saying, why can't you do this in 15 weeks? And genuinely surprised by that. Now, again, that may represent a slightly more autocratic manner of dealing with this, but from a technology perspective, why can't it all be done electronically? Why can't you have speedy turnarounds rather than waiting for significant periods? It's about resourcing in governments, and getting the right resources into government. It's getting the right skills into government, into the regulators to help with that permitting process. So there's certainly examples of where applying modern technology, digitalization, and so on has reduced these permitting processes in a very significant way.
Thank you very much for that. Fiona, do you have some closing remarks?
Looks like Fiona's frozen at the wrong moment.
If Fiona has sort of like frozen, I'll just go and like step in. I think that we're going to obviously like reach the top of the hour. So I think with that in mind, I'd really like to thank all of our rapporteurs today. And a number of you have asked about whether there's a post-show report of the Government Roundtable. There is. You should already have received a link for that. If you haven't, please email me at andrew.fake@resourcingtomorrow.com and I can get one sent through to you. Some of you have also asked about this year's Government Roundtable. We're planning to again run it on Monday, the 1st of December, on the day before Resourcing Tomorrow, once again at the London Stock Exchange. We are currently evaluating what the key themes for this year's roundtable should be. If you have any sort of thoughts about, what those key themes should be, we're very open to listen to your ideas because we're still at a very, very early embryonic sort of process. I think one sort of takeaway I had was from Fiona Clowder's opening remarks about the urgency of the energy transition. And I think suddenly for this year's Government Roundtable, it's certainly my personal view would be to have sort of a really wide range discussion around the urgency as to how we can get it done now, whether it is permitting, whether it is financing, whether it is sort of, resolving some of the supply of critical minerals problems, if it is the urgency of resolving some of the challenges we have with regards to supply chains. For those that are listening in who'd like to become involved at this year's Government Roundtable, please don't hesitate to drop me a line. I'd love to go and hear from you. With that in mind, once again, we'd like to thank everyone for their time today and look forward to hopefully seeing you at Resourcing Tomorrow and also at our Government Roundtable later on in the year. Thank you very much.